Welcome to this Indianomics Deepavali special. How will the Indian economy perform in Samvat 2081? The early Q2 data was weak, be it the nifty earnings forecasts or IIP or GST collections, all of them subpar. The Reserve Bank itself has pulled down its second quarter GDP forecast from first 7.2 to 7% and now to 6.8 in their latest bulletin. But, and this is a very big but, the Reserve Bank Deputy Governor Michael Patra, speaking at the New York Federal Reserve program just earlier this week, said that Reserve Bank retains its full-year GDP forecast at 7.2%, at 7.7% for the next year, FY26, and he sees around 8% thereafter. Now, two big CEOs who spoke to us, Rajiv Bajaj and TVS Motors Management, have also said that the festive demand is robust. So Q2 weakness may not spread to Q3. How will India's growth story therefore pan out in the rest of Samvat and next year as well? Let's ask three top economists. Chetan, Ahya, the chief Asia economist and emerging markets expert at Morgan Stanley, Santanu Sengupta, India economist at Goldman Sachs, and Vishrut Rana, the economist for Asia Pacific at S&P Global. Gentlemen, good morning and thank you very much indeed for joining us on a very auspicious occasion. Well, first up, Chetan, let me start with you. You know, there is all this two-quarter data which we can whine and crib over, and there is this big statement coming from no less than the Reserve Bank. We stand by our 7.2% growth. Where are you? Do you still think Indian growth can be robust this year?
So we are at 7%, Latha, and so we are a tad lower than RBI's forecast. And we also think that when you take the account for the second quarter number, when it comes out, the GDP number could be lower than what we had initially anticipated. We thought it would be 7% as well. But now we are recognizing that there have been some downside risks that has emerged to that quarter's number. And going forward, we are forecasting that growth will revert back to somewhere around 7% in the next two quarters and then decelerate towards 6.5% to 7%. So that's kind of our growth outlook.
Okay. So you're not very far from the Reserve Bank, just 20 basis. But that is not what the bulk of the economists told me. I did a CNBC TV18 poll and people were actually pulling down their numbers for Q2, of course. And the indication was that after Q2 data comes out, they will pull down the full year numbers. Santanu, what's your sense? Does this positive statement from Patra and from people like Rajiv Bajaj and TVS Motors want to, rethink your second half numbers?
Well, Latha, we have been at 6.5% growth for FY25 for about 2 months now. We downgraded growth a couple of months back. The reason at that point of time mainly was that the government capex spending hadn't come through. We had expected some recovery in the previous month. It hasn't. Possibly it's going to recover in the second half, and therefore you're going to get a boost from the government capex undoubtedly. But given how far it is from the budgeted estimates, we have our doubts whether they'll be able to meet the full year's numbers. You've seen it in the previous couple of years as well. You budget for about 10 trillion INR, you ended up spending about 9.5 trillion. You've budgeted for 11.1, you'll probably end up spending a little bit lesser. But there are two other broader macro factors going on. There's a slowdown that we are seeing in the urban consumption landscape. There's a nascent recovery in rural, but the offset is coming from urban as well. Credit card spends data is slowing. There's been a macroprudential tightening from the RBI almost a year back, and it's playing out now, right? So your retail credit growth has slowed down from about 25-30% towards the mid-teens, and possibly it'll slow down more. So when you're tightening macroprudential at the same time, and that's been a very strong lever of growth, that's gonna subdue consumption in our view. There's a fiscal drag that is going to continue into next year as well. And then you think about the world, can't really imagine a net export material boost coming. And therefore, we are happy to be at 6.5% growth for the fiscal year 25.
Okay. Yes, there is a strong case. And I would say at the moment, the majority are on the sub 7% side. But Vishrut Rana, the world is not that bleak. The last GDP number we got from United States is 3% for such a large economy. July, August, September, actual numbers, not even forecasts, is 3%. China is giving a big boost. So do you think there is an upside? What's your number and what's the likely upside tilt, if any?
Yeah, thanks, Latha. I guess we fall somewhere in the middle and towards what you were describing earlier in terms of the macro scenario. So we forecast 6.8% growth for this fiscal year. And part of the reasons have been discussed already. We do see some of the slowdown in the high frequency momentum in the economy. There is, of course, a strong base from last year where growth was fairly strong as well. Over the medium run, we remain positive for the factors that you mentioned, that there is this supportive global growth environment. In addition, the domestic growth drivers are still in place. For India, the capital expenditure, the infrastructure drive, crowding in private investment, the demographic story, technology, all of those factors supporting India's growth momentum over the medium run. And we believe that should push growth into the 7% range at the moment. And as you said, at the moment, external factors still remain reasonably steady.
Yeah, fair enough. I will come to the medium term in just a bit, because that is the larger question we should be asking ourselves. Chetan, just quickly, if you can parse the global environment, you look more seriously at China than many economists. With all this fiscal push, will you see some recovery over there, and will that change the global picture at all?
We think the policy response that the Chinese government has announced so far is actually good. It's significantly positive, but it's unlikely to be a major driver for global growth. We think it's going to achieve somewhere around closer to 5% GDP growth. But that's not going to be like half a percentage point or 1 percentage point acceleration from what everybody else were expecting before this policy announcement. And so I think it's sort of more like status quo. And we read the policy actions more like defensive, trying to prevent further slowdown in growth and a drag on global growth rather than actually a big contributor. But you're right. I think, Latha, you mentioned earlier that the US is doing well. So the US growth is going to help the global economy. And on balance, we should see global growth around 3.1%. That's already our forecast is this year as well as next year. So there is stability from the global side, but I wouldn't say that there is a significant positive tailwind coming from the global side.
Okay, fair enough. Even the IMF's forecasts seem to be just maintaining that 3.2% for the global economy, but they are not lowering it. That's the big point. The global growth picture seems to be counterbalancing, one sector counterbalancing the other. Okay, let me quickly get in an inflation question before I come back to the medium-term growth story. How worried would you be, Santanu? The food inflation number was bad, and October nowcast is not looking any better.
Yeah, so I think there's going to be an overshoot from where our estimates are for the current quarter, given the upside that we have seen in vegetable prices. But these things tend to mean revert pretty quickly. So post December, as you get into the winter season, you're probably going to see a sharp correction in vegetable prices, and you would align inflation. Because you mentioned Dr. Patra's speech earlier. Yeah. He's also said that it'll probably align with the RBI's inflation target in the Q1 calendar year next year, and thereafter in the fiscal year of FY26. That's exactly how we are seeing it. So some upside risk to the around 4.5% number that we have for the current quarter. It'll probably push closer towards 4.8 or so, which is the RBI's forecast. And then you revert back towards a 4.2, 4.3. I think the main point is that if you strip out vegetables, headline inflation is running at 3.5%. And it's been running below 4% for the whole of this calendar year. Okay. Core inflation is running at around 3.5%. So really, keeping aside vegetables, there's no very strong inflation impulse that we are seeing in the economy.
Okay. Well, I'll come back to rate cut expectations in just a bit, and whether RBI will loosen its, as you correctly pointed out, tight macro prudential rules. But Vishrut, what can mar the picture? That's one more question I have to squeeze in before we go into a break. A possible Republican victory. Does that topple things a lot for India, or, India can still chug along?
So in terms of the external risk factors, I think there's a number that stand out. One of them would be, of course, a global change in the financial conditions. So what we've seen over the past couple of years is that financial conditions remain very stable. It is easy for firms to access capital markets and the funding markets. And if that does change because of financial shocks or because of rising interest rates globally, then that does present a complication to our growth outlook. In terms of wider growth momentum, I think we would see Asia Pacific, China growth numbers as well, a slowdown in the US, all being potential factors that could affect the Indian economy from the external side.
We have to discuss more about a possible Republican victory and a rise in tariffs. But I also want to ask about whether there will be an S&P upgrade of Indian bonds. What happens to the medium-term story of Indian growth? How many rate cuts from RBI? All those questions after the break. Welcome back to this Samvat special Indianomics, the Deepavali special. I've been speaking to three Indian economy experts, Chetan, Ahya of Morgan Stanley, Santanu, Sengupta of Goldman Sachs, and Vishrut, Rana of S&P Global. Gentlemen, thank you very much for staying on. Well, before the break, I just touched on one point which might make the global economy shudder a bit, every economy, a possible Republican victory. And now the polls are indicating that that is not outside the realm of, impossibility. Chetan, Ahya, on that issue, would that make you change Indian economy or EM growth much, a likely Republican victory?
So I think, of course, if it is a Republican president and then they decide to put tariffs on not only China, but rest of the world as well, that would be a significant challenge for Asia growth story, particularly because in that scenario, we think that there could be a significant impact on global corporate confidence, global capex, and global trade. And Asia is more trade-oriented. So overall, Asia's growth will be definitely impacted in that scenario. However, if there is a tariff only on China, there is a possibility that the impact may not be as bad as what we saw in 2018-19, because now global corporate sector as well as the Chinese companies are all fully aware about this issue between US and China. And they will probably only accelerate that diversification of supply chain effort that they have already embarked upon. So in that scenario, you will have still a negative impact, but it could be less than what we saw in 2018-19.
Okay. Well, there's no point belaboring this too much. We will know, of course, in the first week of November. And I'll invite you all yet again thereafter for your thoughts. But Shantanu, your number, as you said, GDP growth is at 6.5%. Let me present the other case, why your figures can be challenged. There is an excellent harvest that's on our hands and reservoir levels are very high. So it's expected that rural demand will pick up in the coming months. And then there is this slightly medium-term expectation that there can be an upgrade of India's rating. Macros improving consistently, as you pointed out, on inflation front as well, fisc as well, tax collections, tax to GDP. You think all that can change the medium-term picture and the second half?
So, Latha, 6.5% compared to the emerging market world is still pretty strong growth.
Oh, excellent, yes.
And we have no doubt that the macros are very strong. I mean, India's current account deficit is around 1% of GDP. Inflation is within the target band. Balance sheets, both on the corporate sector side and the bank balance sheets are very strong compared to probably any other cycle previously. But it's just that, even if we bake in the nascent rural recovery for all the reasons that you mentioned, which is already baked into our forecast, we are not seeing a significant boost which takes us towards a 7% or 7% plus number over the second half. I think where we could be surprised in terms of the numbers is if the private corporate capex recovery becomes more broad-based, and there's really animal spirits that goes through the system, and there's a huge boost in private corporate capex, that can definitely push our numbers. I mean, that would sort of push us to push our numbers up towards 7% or so.
No, that's a fair point. Then, one can also say on the downside that first the MFI loans are becoming difficult, unsecured debt. The next, will secured debt also start to wobble? You can present a negative picture as well. But Vishrut, Rana, what's your sense of, I don't know whether I'm putting you in a piquant situation by asking you whether there are chances of a rating upgrade. But if that were to happen, let's assume it happens. I know it's not in your hands. Can that materially change growth prospects? Because cost of capital falls for business.
Yeah, no, thanks, Latha. No, I did see that line of question coming. So yeah, so with the disclaimer that I'm not part of the sovereign ratings committee, so I would not be able to provide too much more insight on that. Of course, we do have at S&P, we do have India on a positive outlook at the moment, which means that there's a material chance of a rating upgrade over the next couple of years. That's reflecting some of the strong macro fundamentals, the improved spending profile of the fiscal that our sovereign colleagues have flagged. In terms of how that affects the growth outlook, I think there's of course a more nuanced story regarding that. India's cost of capital does depend very significantly on global financial conditions.
Yeah.
So I think that would be the key watch factor for me as an economist in terms of what is the cost of funding for India and how much spending can be sustained over the medium run. That would ultimately depend on the path of global interest rates.
Okay. Yes, that it does. But, even no matter what the path of global growth and global interest rates are, when a country is on a demographic advantage, when it is in an inflection point, like China was in 1991, irrespective of what the world went through, China just went from strength to strength. Santanu, that medium-term question to you. Do you see the coming together of these factors, the China plus one, the preference for India, the geopolitical advantage and the demographic advantage? Can it mean a much better medium-term story, as Dr. Patra is saying?
I think our medium-term forecasts right now are in the region of 6.5% to 7%. We have done, a lot of work on, where potential growth is for India from the supply side. And it told us that, if you raised your labor force participation rates, you could actually push growth sustainably higher towards the 7+% kind of range over the medium term. And I mean potential. So, cyclically, you could go up to 7.5, and then again fall back to 6.5, which is where we think currently potential is. The tailwinds are all in India's favor. I think what will be important is the broadening out of the capex cycle so that, you're creating more jobs across manufacturing as well as services. Can't really be a one-side story for India. It has to be pretty much spread across everything. I think the last point I would make is that in terms of cost of capital right now, also if you see that even with the government borrowing so much, you have a pretty flat yield curve in India in the long end segment. The 10s, 30s is like super flat.
Yeah.
So it's not like cost of capital really is what is holding back.
Absolutely. I mean, I can rattle off the negative factors as well. After all, how many tax filers do we have? 8 crore tax filers, of which the people who actually pay tax, direct income tax, is only 3 crore, or 30 million. And therefore, even if you multiply it by a family of 5, we are not speaking of a very, very large consuming class. There is a lot of work to be done when you look at in the medium term. So last word to you, Chetan, Ahya. How much would you give, would you lean towards Michael Patra's forecast that in the medium term, 8% is a possibility?
So, of course, it's a possibility. But, Latha, in our base case, we have similar to what Santanu mentioned, 6.5% to 7%.
Okay.
And I think that number is still pretty strong enough. And I think this is going to ensure that India still reaches that, third largest economy by 2027. So I think it's all track and it's all pretty good. I think 8% and 9% is what probably is required. But at the same time, to achieve that kind of number, there have to be a lot of changes in the economy from supply side, labor reforms, labor force participation rate, and more importantly, also consistent development of infrastructure across all segments and all sectors, not just a specific area. And to pull all of these things together on a consistent basis, we think that at this point of time, it would be best to assume something like 6.5 to 7%.
Okay, 6.5 to 7% we would, take with both hands. But I would still perhaps let us foregather 3 years from now and check whether Michael Patra has made a point which others did not see. Ultimately, I'm a market reporter and this is a market show, so I will have to ask you 3 rapid-fire market questions. Okay, Chetan, where do you see the 10-year and where do you see the rupee, the range? Where does Morgan Stanley see 10-year yield and rupee over the next 12 months?
So, Latha, unfortunately, I'll give you some boring answers to this one, and that is our house view. So we are neutral on the dollar, and so therefore we are not expecting much volatility in the rupee. It should remain in a stable range.
Okay.
And same view for the 10-year.
Okay.
Yeah, the domestic demand is good for long-term paper. There's also this foreign portfolio inflow that is supportive. So we expect it to remain in the stable range.
Okay. Well, Santanu, Vishrut, you'll have to keep it brief. Santanu, rupee range, yield range, next 12 months.
Early 84 in the near term for the rupee, which goes towards 83.5 or so over a 12-month period if the dollar weakens a tad. On the 10-year, we don't really have a forecast, but we have a trade on in the 2-year long bond segment.
Okay. And Vishrut, yields and rupee.
Yeah, so on the rupee, we're around 84, similar to what the others have been mentioning. We expect a gradual depreciation trend of the rupee, so that's something that we're looking out for. We don't really have a position on the 10-year yet.
All right. Gentlemen, thank you very much for joining me in this Diwali special. And all of you have a grand Diwali, you and those close to you. The message, 6.5 to 7% in the medium term is a very good number, but I would still give Dr. Michael Patra's 8% a good chance to be the medium-term growth for India. That's it on this special Indianomics. Thanks for watching.